Here's a little spreadsheet that starts recording transactions for a company. I just want to give you highlights here. Each of these up here is an account name: cash, accounts receivable, supplies, equipment, accounts payable, common stock, dividends, revenues, and expenses. Obviously, you're going to record any transaction that includes a change in cash under this account, accounts receivable or supplies or equipment in each of their accounts. And let's talk about what these are. This side is assets. These are asset accounts, things we own of value that we are going to consume in some way to earn revenue. This is a liability. This is something we owe to somebody. You notice the equal sign here. Assets, the total of all the assets equals the total of all the liabilities and the equity together. So the left side, assets, equals the liabilities plus the equity. You'll notice here that we started out with a $30,000 investment in cash in exchange for common stock. That's the first entry. And so cash came into the company, and the company gave the investor $30,000 in common stock. And you notice that's on opposite sides of the equation. Cash went up, common stock went up. That means equity went up. So you can see that the equation is the same. This is just the sum of the different items. If it ever gets out of balance, it will change to no over here. I've kind of got it set up that way. The second one, the company purchased supplies for $2,500 in cash. So cash went down. In this case, you can see it's in parentheses. That shows it going down. But supplies went up. So nothing really changed in the equation. We just took one asset and exchanged it for another asset. So both sides remained the same. No real change in either side of the equation, except we just moved one asset to another. For the third one, we purchased equipment by paying $26,000 in cash. So pause the video and see if you can do this one. Now I'm coming back, and we purchased equipment by paying $26,000 in cash. So equipment went up, and cash went down. Again, one asset traded for another. Let me put these in yellow, and we'll put all these in green. Kind of messes up my shading, but we'll be all right. So the balance in the account, $1,500 in cash now. Nothing has changed again on the equity liability side because we just traded one asset for another. Number 4, we purchased supplies of $7,100 on credit. So supplies went up again, and we didn't pay for it, so cash didn't go up, but liabilities went up. We owed money for this. We purchased it on credit. So accounts payable is our liability. That's the one we have, and that would make sense. And you'll see that the liabilities went up and supplies went up. So now if you think about it, we have $37,100 in assets, and we also have $37,100 in liabilities and equity. Number 5, the company rendered consulting services to a customer and received $4,200 in cash. So again, pause the video a second. See if you can do this one. We received cash, so $4,200 up for cash, and revenues is the money we earn. Revenues went up. We earned $4,200 in revenue. Let's see. Now we have $41,300 on each side. $30,000 plus $7,100 plus $4,200, and then $26,000 plus $9,600 plus $5,700. Cash went up, and revenues went up. Asset, equity. Number 6, see if you can do it. We paid rent of $1,000. Okay, so that rent is an expense, and I'm going to go ahead and put this in as a positive number. This because even though it's on the equity side, you can see that it's a negative. So expenses and dividends reduce equity. Revenues and common stock increase equity, and of course liabilities are increased here too. So they haven't been changed right now. But cash went down. We paid cash for $1,000. So negative $1,000 in cash, and you'll see that that makes it balance. Again, that gives us $40,300 on each side, both in balance. Number 7, you can pause if you like, but we paid cash salaries of $700 to employees. So our expenses went up, which reduces equity, and we paid it out of our cash. Let me see it. You see how this is balancing over here? The total of the assets equals the total of the liabilities and equity. Let's just pretend that I forgot and I put this in as a positive number, and you'll see this doesn't balance, and the totals in my accounts won't balance either. We're off. I hope you understand that. We need this side, the yellow side, to balance with the green side. If it ever doesn't balance, we've made a mistake. All right. Number 8 says that the company provided consulting services of $1,600 and rented its test facilities for $300 to a customer on account. That means we didn't get the money. We did it on account. That would be accounts receivable. They owe us this money. So it was 2 types of revenue. One is consulting revenue and one is rent revenue. So we put them on 2 different places. The book put all this over here in accounts receivable in one number. I'm happy with that. That leaves us with an out of balance situation over here. So just to make myself happy, I'm going to put them both down separately. And that gives us back over here to everything and being in balance again. Just being nitpicky. But the assets went up. It wasn't cash this time because we did it on account. We earned the revenue, 2 different types of revenue, consulting revenue plus rental revenue, and it went onto our accounts receivable. Now number 9, the client transaction 10 days later pays us for after it is billed. So we billed them and sent them the money and they paid us. In this case, they're going to pay us $1,900. And it comes off of the accounts receivable. I'm not going to record the revenue in here, nothing else, because we've already recorded the revenue. This is just he owed us the money and now he doesn't. And you can see here that just makes it perfectly balanced here. We can take our totals again, and we should be in balance again. Didn't change the totals because it went from one asset, accounts receivable, to another asset, cash. 10, fast forward pays, this is us, $900 as a partial payment for the earlier purchase of supplies. So we purchased supplies in number 4, for $7,100, and now we're going to pay $900 of that back to them. So cash is going to go down, and this accounts payable is going to go down too. We don't owe him $7,100 anymore. We owe him, what is that? 6,200. We'll see if my math cells are working today. Yeah, 6,200. So assets went down by 900, liabilities went down by 900. Everything's in balance. 10. No, it's number 11. I'm sorry. Fast forward. Declares and pays a $200 cash dividend to its owners. So dividends are going up, which reduces equity. Remember, dividends and expenses reduce equity, and cash goes down because we're paying these dividends to the owners. And there we go. There is no 12, 13, and 14, but you can see here every one of these balances, every one of these assets, whatever we did to the assets, changed over here to the equity, unless it was a situation where one asset was traded for another asset in the case of the equipment, or one asset, accounts receivable, is traded for another asset, cash, when they paid us. In those cases, we don't have a real change in the amounts on either side, but it still keeps the equation in balance. Everything on the left balances with everything on the right. Now, if you add these up, you can, let me see if I can do this. We have our revenues and expenses over here. So net income oops, sorry, I should have done that differently. Revenues minus expenses, my net income appears to be $4,400. $6,100 minus $1,700. My retained earnings after all this is done, let's see, retained earnings is going to be the net income minus the dividends. And it's $4,200 because we paid out that much in dividends. If there had been retained earnings from a prior year, we would take the balance on retained earnings plus net income minus dividends to get to our ending retained earnings. And so for the balance sheet, we add up the assets. See if I can do this. Oh, let me do it this way. Do it at the bottom here. $40,400 in assets. Nope. Equals common stock minus dividends plus revenues minus expenses. And that gives us $34,200, and we're balanced. Assets equals liabilities plus stockholders' equity. On the balance sheet, we would have all our assets, and we would have everything except dividends and expenses and revenues. All those would be rolled into one thing. So you would have accounts payable, common stock, retained earnings. And if you add those up again, $40,400. You don't need revenues, expenses, and dividends anymore because I've got it in common stock, and that is a permanent account. Expenses, revenues, and dividends are all what are called nominal or temporary accounts. They're closed at the end of the year when we do our financial statements. So our first financial statement would be the income statement showing net income of $4,400. Our next statement would be the statement of retained earnings, which shows a balance of $4,200 at the end of the year in retained earnings, and that is a permanent account too. So you take all your equity at that point at the end of the year is common stock and retained earnings, and then you add your accounts payable to it to make your balance sheet work. Anyway, I hope that helps.